so much for your kind introduction. And thank you everyone for your attention today. It's an exciting time to be talking about gold and silver and why we are in a bull market for those metals. And what I will focus on certainly in the second half of my presentation here is what to do about that bull market, how to build a precious metals portfolio that works for you. So I will start with some overview on gold. I know that we have gone through this at the conference already, but I'm going to give you my thoughts on the gold market. To start with, I want to say gold is complicated on a day-to-day basis. For example, gold will gain inherently when there is risk in the market, but it is also hurt by strength in the US dollar, which happens at the same time. So that's a push and pull that happens simultaneously. Similarly, it thrives on economic uncertainty, that's that risk thing, but it also gains with inflation, which comes with confidence. So that's, again, a confusing pair of forces. Gold is commonly thought to move against the stock market, but that hasn't been the case for the last decade. So that's a changing dynamic. And I would say in general, gold's first reaction to major macroeconomic events often is not its inherent reaction, but rather it stems from a bigger market. The main ones being the US dollar, the bond market, and stocks. Those are so much bigger than the gold market that they make the moves that they make in relation to some event, and gold gets whiplashed about as a result. And then after the fact, gold sort of has a chance to do its own thing and establish its own move in relation to the event. Those complications matter and they don't matter. If time is on your side, so you're not trying to trade your portfolio for tomorrow, but for some medium-term time frame, these details don't actually matter. What matters is that the precious metals market is going up from here. So the primary reason to believe that is that we are in a negative real rate environment, and we got thrown down into that negative real rate environment by the pandemic. We were headed that way already, but we got pulled far deeper into it with the advent of COVID-19 and the global shutdown. And we have now been assured by, Powell of the Federal Reserve in the United States, which is the most important central bank, but also by other central banks around the world, that we will remain in a negative real interest rate environment for years. I think it's important to look back and remember that it took the Federal Reserve 7 years to raise interest rates following the Great Financial Crisis. That's a long time. I don't know that it will take 7 years this time, but it's still a useful time frame to consider when you're thinking about how long this setup will persist. And I think the take home is we have years ahead of us of negative real rates because there's all kinds of forces that are pushing central banks to keep interest rates very low and having central banks push as hard as they can for inflation. Zero rates plus inflation equals negative real rates. When real rates are negative, then dollar-based holdings do not pay. And so those who need to diversify their portfolio or need a safe place to put money or need to diversify their stock portfolio for risk, need a safe place to put those dollars, gold becomes one of the only options available to them. Speaking of dollars, one thing that has impacted gold in the last few years for sure is strength in the US dollar. I certainly believe that there's reason to think that the US dollar bull market run is over. It's not going to fall off a cliff from here, but that real bull dynamic is probably done. Key to that, gold and silver went on the run that they went on in July and August because of really rising inflation expectations. There's lots of, I could spend my whole talk about inflation expectations, but I won't. It has to do with money printing. It has to do with stimulus efforts. It has to do with debt levels. It has to do with zero interest rate. But inflation expectations are really rising. That is, of course, weakness in the US dollar. Then there's the fact that China has a very long game to reduce its reliance on the US dollar. That is only a weakening force and will continue to be so as it progresses. There's the ballooning money supply. There's the debt loads that are so immense that they certainly drag on the currency. And then there's trade wars. And certainly when the US-China trade war was at its worst, that hurt the US dollar. As optimism increased, the dollar rose again. But that trade war is by no means over. It's been sidelined by a whole host of other things, primarily the pandemic and the presidential election, but it will return, I'm sure. So that US dollar bull market that has hurt or hindered gold in the last little while, I think will be less of a force going forward. Now, I talk about gold as the safe haven, and it always is a safe haven. It has always played that role, but things have shifted since the great financial crisis. Huge pools of money that have low risk tolerance used to own bonds. That would give them 5 or 6% annualized return from yield, but that game does not exist anymore. You cannot get yield from bonds, whether corporate or government. And so those big pools of low risk capital have to own stocks. That's been a transition underway since the monetary games started happening following the great financial crisis. And that's okay, but the risks to the stock market are real. I will not try and predict what's going to happen to the stock market, but I will say that the risks are very real, and low risk capital has to hedge those risks. So what does low risk capital do to hedge its huge exposure to risk by owning so many stocks? Well, it can't own bonds. That was the beginning of this conversation. It has to own gold. Gold is pretty much the only option to diversify against that. The charts that I have here are just examples. The bankruptcies chart is just an example of the risks in the US economy right now, and therefore to the US stock market. Of course, the market is moving primarily on stimulus, not on real fundamentals, but the risks are absolutely there. And the tweet that I've captured on the right side there, I just love it because it captures what's going on in the corporate bond world, which is that you buy bonds that yield less than inflation from super indebted companies. It's just underlines how the bond game doesn't exist. So this low risk capital has to own stocks, and it has to hedge that risk of owning stocks. And so it has to own gold. Then I want to look at a few of these things that are dominating our thoughts and our headlines and our markets right now. And the reason that I want to look at this is because these things matter. And I actually believe that gold is set to do well no matter which way these things go. It's an interesting statement to make, and it's a very bullish one. So the US election, if Biden wins, guess what? We get more benefits, we get more money printing, we get more debt, and the result of that is inflation in a zero interest rate environment. If Trump wins, he will continue to do whatever it takes to support the stock market and the economy. So guess what? We get money printing and more debt and stimulus that means inflation in a zero interest rate environment. Both presidential candidates will maintain a negative real rate environment and take us deeper into that in all likelihood. So gold wins no matter what. If COVID gets worse, people go to safety in a zero interest rate environment, that benefits gold. If COVID improves, then you get growth-based inflation in a zero interest rate environment. That benefits gold. Same with the trade war. You can look at it from a flight to safety or inflation-based growth, and gold benefits either way. That's just how this strange monetary and economic setup has left us. But for those of us who bet on gold, it really means that these really unpredictable, difficult forces that are on a day-to-day basis hard to manage right now, take a step back and realize that gold is going to work over just a slightly longer term time frame, no matter what happens with all of them. Okay, so if we're in a gold bull market, what kind of upside do we have ahead? Well, almost no matter what metric you look at, whether you look at how much investors currently have allocated to gold versus what they do at the peak of a market. If you look at the gains that we've had in the gold silver market to date relative to past markets, if you look at what gold stocks are pricing in as a premium to the price of gold, which is what's on this chart, relative to past markets, they all tell us that there's a huge amount of upside ahead. That's what matters. There is both time and history is on our side for upside ahead in the gold market. Okay, so then quickly, if everything is so fantastic for gold, why are we currently in a bit of in a moment of gold price weakness? For a few event-based reasons. The one that kicked it off was the death of Justice Ginsburg. That took that stimulus package that the Democrats and Republicans had almost agreed on off the table. The market had priced that in already. They thought it was going to happen. The markets move on stimulus these days, not on reality. And so when that stimulus package evaporated, then those inflation expectations that had been rising and driving gold and silver, they dipped. And the market in general had a fit, and gold sold off with everything else. In parallel to that, for very similar reasons, we had a flight to the US dollar in reaction to the lack of stimulus because of that dip in inflation expectations, and because the euro turned down because case counts in parts of Europe were particularly bad. And then there's just a time of year thing, which is September, brings a lot of portfolio rethinking, and traders come back to their desks after holidays and will often lock in gains that happened over the summer. Gold certainly fit that bill, so that probably fed into the dip as well. This I will just touch on briefly. I think speculative betting on gold silver price directions on futures in China has really worked to amplify the gains in July and August in gold, and particularly in silver. And then, of course, when the tables turned, it added volatility and downside when things turned down. This has to do with access to money. Easy money is the phrase that we often use. A lot of individuals and companies, both private and public, got into betting on gold and silver futures. That's a super fun game when your bets are right, because you make a lot of money very quickly. And then it becomes not so much fun when the market turns against your expectation, and the $1 billion that you built up in a short period of time, in 5 weeks, can evaporate in a matter of days. That's what happened in this example company that I've put up here. They were betting on silver futures, and they took all those bets off the table in the space of about a week after, guess what, a huge amount of their gains just evaporated overnight. Right now, so because of the holiday closure in China, that force has been largely missing for the last weekend change. It will be interesting to see to what extent it returns after the holidays are over, now that gold and silver are not just rising ceaselessly like they were in July and August. I just mentioned this because it certainly added to the up and to the down in the last few months. I think it's a force that we will see less of going forward, and it's just a bit of context. Okay, so what I've gone through there is just my rationale for why we absolutely do have a gold and silver bull market. So then the question is, how are you going to profit from it? What should you as an individual do to take advantage? The message that I like to be very clear on is you do not have to be an expert on gold and silver or on gold and silver stocks. What you do need is to understand the forces that impact this market and decide that we are in a bull setup. That's where I've just brought us to. You have to watch those forces enough to see when the setup changes. I don't think that will happen for a few years, but that's part of the fundamental setup. And then you have to know yourself. You have to decide how much time you want to commit to your precious metals portfolio and how much risk you want to tolerate. When you can answer those questions, then you can set expectations for what you're trying to do, and you're much more likely to achieve them if you know what it is you're trying to achieve. What matters is that whether you're a trader or an investor, whether you like to speculate on high-risk discoveries, or whether you build a portfolio with leverage to the price of gold, it all works really well in a precious metals bull market. It just has different risks, it has different timelines, and it has different needs. Okay, so you need to decide which game you're playing, then you can play a game that works for you. The charts that I put up here on the left is GDX, so just major gold miner index. It's up 56% year over year. That's fantastic. 56% is a great gain. The one on the right is a junior explorer called Evergold. It was up 300%. Wow, that gives people fear of missing out. But look what else happens, right? That's discovery for you. Discovery is a difficult game. And so decide which of those you want to play. I'm not saying that one is better than the other. It all depends what you want to do. Now, if exploration, if betting on discovery is your thing, that's great. But just remember that it's very risky. A lot of junior companies have been able to raise money in the last half year. And so there's a huge amount of exploration happening right now. That increase in the number of targets being tested means that more discoveries are happening. But don't let that make you think that the odds of success on any one target have changed. They have not. Discovery remains a very risky, low odds game. So there's a few ways to manage that risk. I'd say the most important is that you demand that any company that you're looking at has more than one thing going on. It has more than one good target in its project, or it has more than one good project in its portfolio. At the end of the day, geology is risky enough. So manage that risk with more than one target, and then ensure that the company has limited the other risks on the table. So make sure that they have permits, make sure that they're not limited by seasonality, make sure that they can access their projects and that they're not spending oodles of money on logistical challenges, make sure that they know how to tell the story to the market. Consider all the risk factors at play. I'm going to go through this quickly. I feel like this is a bit detailed for the audience that I'm speaking with right now. But what I want to, the message on this chart is that if you're trading explorers, you have to trade them. You can't just buy an explorer and hold it and expect that it will work, because exploration is too risky for that. You need to pay attention and decide if you're going to take money off the table if the price runs ahead of results. What are you going to do if the drills do hit? Are you going to get attached and stay in? Are you going to take some of your gains? Are you watching free trade dates? When companies finance, they issue stock at a set price. If the stock gains in the following 4 months, there will be pressure when those lower priced shares come free to trade. There's a lot of things that you need to pay attention to if you're going to trade exploration stocks. If that's not appealing, that's okay. It's okay to not want to trade. You can absolutely build a buy and hold portfolio that will perform through this market and will require little attention or risk. You can buy large leverage stocks like Barrick. That's why Warren Buffett bought Barrick. It provides leverage to the price of gold as the largest gold miner out there. You can buy scale and growth, so mid-tier to major miners that have particularly strong growth profiles. You can own royalty companies, which have reliably outperformed miners in the bull market, the bear market, and the bull market. It's hard to argue with that track record. You can buy optionality plays. Huge assets are specifically hated when the markets are weak because they're so expensive just by being big. But when the markets get strong, the few big assets that have continued to advance become very sought after because big companies need big assets to stay big. That's the optionality play. You can try and identify takeout targets, which are companies that are likely to do well, whether they get taken out or continue on their own through the market. And you can, of course, bet on silver, which outperforms gold every market. And then there's a middle ground where there's companies that offer some of that fundamental growth paired with exploration splash. So these companies usually have a reasonably advanced asset that has good exploration going on as well, or they have just a strong portfolio of exploration targets. So the fact that there's additional targets means that failure at one is not as fundamentally, it doesn't impact the price as much as it would if they only had one target. My take-home message is that this is we are set up for a few very exciting years in gold and silver. Corrections or moments of weakness like we're going through right now are part of the process. What you need to do if you want to play is consider how much focus and risk you want to commit. And then based on those decisions, you want to build a portfolio that works for you and then stick to that plan. Don't get fear of missing out on something that was not part of your plan. And then of course, I stick in there, find a few good sources of information. It's a complicated market. That's what I try to do, is provide investors with good sources of information about the macroeconomic setup and about individual stocks. If you'd like more information on what I do to provide investors with that information, please visit my website. And with that, I am done speaking, and I'm happy to take any questions if anybody has one.
Thank you, Gwen. There's quite a few questions waiting, and maybe I start off by having one of those from Barry T. He's asking, is it too late to build a gold silver bull market portfolio? Of course, the short answer must be, but maybe I add that to it. So what's the typical maybe market cycle and average? And what do you think of this metals bull market? What's your thoughts on that?
Absolutely. It's a great question. So there's lots of great charts out there that break down how gold silver bull markets usually progress. A few points to put in there. Time frames are often, I'd say 5 years is a pretty average time frame there. That usually gets broken into two parts. You get a phase one where things ramp up and then come off again. And then phase two officially starts when you're rising and you get past the peak of phase one, then you're into phase two. Phase two gives you bigger gains and lasts longer. And we're literally just at the start of phase two right now. That's the easiest way of capturing it. You can also, whether that's looking at it from sort of like a time frame perspective, you can also look at gains. And we are, the markets are up 12 to 20% relative to gains that usually go to the 80% type range. Or you can look at investor allocations to gold and silver. So if you look at large pools of money, they're their bear market allocations to gold and silver are minuscule, almost non-existent. And as a bull market establishes, they start to rotate some capital in, and you end up with a few percent from big pools of money by the time we get to the peak of a market. We're still very early in that rotation as well. So from almost anywhere you look, we're still really early in the game.
Okay, that's great news to hear. The second question coming from David C here. He's asking, usually gold tied in with for US dollars. So what's the comment on why why is the price of US dollars still pretty strong, but gold price is breaking out? What's your thoughts on that?
Yeah, for sure. And gold and silver, the fact that we pay the most attention to gold priced in US dollars, of course, means, as the questioner was getting at, that they should move in opposition. But the other really important factor is that they are both safe haven assets. And so when there is risk, investors go to both of them. So if you go back over a multi-decade timeline, you can absolutely see that there are lots of time frames which are more normal market conditions, not dramatic in terms of risk or growth. So they're not really good and not really bad. All the times in the middle, gold and the US dollar generally do diverge. But when you're in a high risk environment, or when you're in a high inflation and growth environment, they often move together. And so we're certainly in the risk end of that right now. They're both safe haven assets. And so that bodes well. I also, of course, think that US dollar strength is not going to be as important a force going forward, but they certainly can move together. Don't think that it is dogma that they have to move in opposition to each other.
Okay. And the next one, he was asking, the last super cycle we got so many low grade, high cost projects that fail. What do you think will happen to these assets and companies this time around?
That's a fantastic question. So certainly the questioner is getting at one of the key failings of the last bull market is that major mining companies all focused on growth and not on money. They should all be about making money by producing gold and silver, but instead they were about producing gold and silver, and hopefully making money while they did it. Guess what? That didn't work out very well. They spent too much on projects that were low grade, high risk. A lot of those projects failed. There were billions and billions of dollars in write-offs because of all of these failed projects. I truly think that that will not happen this time around. Those memories are very fresh. The bear market that resulted was terrible. Management teams at every major mining company have been revamped, and there's been a change in culture. There's been a huge amount of discussion through the bear market about exactly this. There's been some really key leaders in the space have stepped forward, and the mantra now, and I mean, we're in the midst of sort of conference season in the mining space, and so I've been listening to a lot of people speak, and I've been having lots of chats with people and listening to lots of presentations from major mining companies. Everybody is focused on cash flow, on balance sheets, and growth if it works for cash flow and balance sheets. So that means that I don't think we're going to get that slew of overpriced acquisitions. It also means that the optionality game isn't as forward as it was in the last cycle. You're not going to get all of these huge low-grade assets getting bought. The really good ones, so not that low grade, but still huge, they will get bought because big companies need big assets to stay big, but they're going to have to be good assets. So the optionality game, I think, will work really well, but you have to be more selective. And I think majors will not make as many of the same mistakes as they made last time.
Okay, that was a great insight from you. I think we're running quite a bit over time here, so we will conclude here, Gwen, and thank you again for your time here with us today.
Absolutely. Thank you everyone for your time and attention, and I look forward to getting to know you all a bit better.